So hello everyone guys, and today I'm recording a video about top 5 mistakes in trading sessions. If you are tired about missing your trades, losing your trades, this video is for you. Just in 10 minutes I will cover all your mistakes, and if you will fix them, you will get a huge amount of profit. And don't forget to stick for the end. At the end I will show you one secret tip that will increase your win rate. So the first one is all about risk management. It is the most important part of trading. You can lose 10 deals in a row, but if you are following your risk management rules, you will not lose a big amount of money. And if you get a win rate about 50% and risk ratio 1 to 3, you are always gonna be profitable in this station. Many traders jump in trading without calculating risks. It's not right. This can lead to devastating losses and to the liquidation of your future account. Follow the golden rule and don't waste more than 1 or 2% on a deal. Imagine having 10,000 in your account and risking 1,000 on one trade. It only takes a few wrong moves to wipe out your account. Instead, manage your risk smartly. So
Don't forget to subscribe my Telegram channel where I write my thoughts on the market, useful information about trading and post my trades. Have fun!
what about risk management, guys? As I said in previous videos, what you can watch here in the angle of the screen, to master your risk management you need to use this tool, what always helps to the traders to calculate their positions correctly. For example, I will take a short instrument. For example, here I'm entering a short deal with conservative stop loss on the VUG and with a take profit on the capturing of liquidity. And now I can set all the settings. Just double click on that, set your amount of future account. For example, you got $100 and you're risking for the 1% here. You can add your exchange funding here, but don't worry about that if you are not scalping trader. Just set 1%, and if you had $100 on your account here, you will see how much of your active you need to buy. Open positions to get a correct. Here we get 1 to 4 risk reward ratio trade. For example, here we are risking by $1, and if you are winning, we are gonna get $4. So if you are entering a trades like that in a long distance, you always are gonna be profitable trader, because 4 losing trades cover 1 successful trade. So now let's talk about one of the biggest pitfalls in trading, chasing trades. This is when you see the market moving rapidly in one direction and you jump in because you don't want to miss out. It's a textbook case of FOMO, fear of missing out. Instead of sticking to your plan, you abandon your strategy just to catch a move. More often than not, this leads to unnecessary losses. Example: imagine you are watching a chart and that suddenly there is a massive green candle. It looks like the market is exploding and you are thinking, I've got it now, before it's too late. So you jump into the trade without doing any analysis. No confirmation, no plan. But then, just as fast as the price spiked up, it's reversed and you are left holding a losing position. Sound familiar? It happens to the best of us. Chasing trades is a natural response. As humans, we are wired to react to excitement, but in trading, excitement is your enemy. The market is designed to tempt you into impulsive decisions, and if you let emotions take over, you're always on the step behind. So now let's get a tip how to avoid that. The answer is simple: patience. Don't let the market dictate your actions, wait for your setup, stick to your plan, and to only trade when you have a clear confirmation. Remember, the market will always give you more opportunities. Don't feel pressure to act on every move. So the chasing of trades always look like that. So guys, I really hope you don't want to see this picture on your screen. So don't overtrade, don't chasing trades. If you are losing it, your trading plan are incorrect and you need to wait for another day, for now trade to enter a good deal. Another day is a better day. You're gonna become a better version of yourself. I'm Naknet. We'll dive into mistakes. Coming up next, we'll dive into a mistake what even more damaging. It is something that can quietly drain your account without even realizing it. Stay tuned. Mistake number 3 is overtrading. Next, let's tackle another major mistake: overtrading. Overtrading is when you take too many trades in a single day or a week, often out of boredom, revenge trading, or the constant spark to make money. It's a trap what many traders fall into, and it's one of the quickest ways to delete your account. The reality is, overtrading doesn't mean more profits, it means more mistakes. Picture this: you had a losing trade, and instead of stepping back, you think, I need to make that money back right now. So you start taking trade after trade, looking for quick wins, but with every impulsive trade you are digging yourself deeper into the hole. Or maybe it's not even about losses, maybe you are just bored. You see the market moving and you convince yourself what you need to be in every trade. Either way, the result is the same. You are trading for the wrong reasons and it's costing you. The mistakes is rooted by psychology. As traders, we often equate activity with progress, thinking that the more we trade, the more we'll earn. But in reality, trading is about quality, not quantity. One well-planned trade is worth more than 10 impulsive ones. The solution to overtrading is discipline. Set a daily or weekly limit for the number of trades you'll take. Even more important, stick to your trading plan. Only other trades what meet your criteria and avoid trading just because the market is moving. Remember, you don't need to be in the market all the time to be profitable. If you see the candles like that, always wait for reverse or re-entering to this point of interest zones to see on the low time frames the better ways to enter a deal, and only after that get good stop losses and take profits. Don't chase an impulsive movement if you are not a scalping trader. And if you see the big impulsive moving on the higher time frames, don't trade that. It's very risky, the volatility is high, and if you don't want to lose your money, forget about that and wait for the better chance to entering a deal. Mistake number 4, not having a trading plan. Let's be real for a second. Trading without a plan is like jumping out of plane without a parachute. You are not just gambling, you are gambling blind. A solid trading plan is what separates a disciplined trader from someone who's just guessing. Without it, you are at the mercy of your emotions, and in trading emotions, you are a worst enemy. So what does a good trading plan actually look like? It doesn't have to be overcomplicated, but it must be precise. At its core, a trading plan should include 3 things: entry and exit criteria, when do you get in and when do you get out. This could be based on technical indicators, price action, or how much you are willing to lose on a single trade, what's your position size, this is where stop losses come into play, and adaptability for market conditions. The market isn't static, you need a strategy for trading, consolidating, and volatile environments. Think about this: if a pilot has a pre-flight checklist, why wouldn't a trader have one? Your trading plan is the checklist. Let's say you only trade when the 3 conditions are met. Price touches a key level, RSI is oversold, and there is a bullish candlestick pattern. If even one of these conditions isn't present, you skip the trade. It's that simple, and you can save your money from a lot of unnecessary losses. So what trading plan looks like? For example, as for me, a day trader, I gonna use time frames from 4 hours to 15 minutes to open a good deal. After I opened my chart, I always analyze the trend of the movement. For example, here I can see the downtrend movement, the breaking structures, the filling of this Fuji, and form it for another one. For example, here I already can see the one possible way for entering a good deal on the retest of this Fuji. Now I get the all information what I need. Of course, I can place some markers on my liquidity pools, and here we can see the gathering of good amount of liquidity. And here too, I think now the price are gonna go up to retest our Fuji, and after that we will see in 2 ways: a correction or going up to catch the highest liquidity and get the month all-time high. After that, I'm following the 1 hour time frame. What I can see here, we don't have any good zones for entering a long deal, so we don't waiting for good formations for corrections. Here we can place a Fibonacci grid to determine the premium and discount market. Here we have the price in our discount market zone, and with Fuji in the premium market, so we are waiting for the retesting of this zone. And after that, I entering a 50-minute time frame to get a good deal with conservative stop loss, like about that, from 50% with stop loss like that, and capturing of liquidity here. And now we are waiting for this deal. So it is my trading plan. It's just example and it's very simplified. And the last one tip is ignoring market conditions. As I always say, you trade by your trend. Trend is your best friend. Here is a hard truth: markets are constantly changing. What worked yesterday might not work today, and if you are using the same strategy in every condition, you are setting yourself up for failure. The biggest mistake here is not recognizing where the market is trending, consolidating, or highly volatile. Each condition requires a different approach, and ignoring that can wipe out your profits. Let's imagine you are using a breakout strategy. This works get into trading market when the price action is explosive. But now imagine trying to use the same strategy in a consolidating market, where price is just bouncing between supports and resistance. What happens? you'll end up getting whipsawed and retraced with immediately reverse. It's frustrating, but it's also avoidable, and if you understand the context. The mistake comes from tunnel visions, focusing only on your strategy without looking at the bigger picture. You need to ask yourself, what is the market doing right now? Is it trending, ranging? Are we in a low volume session? Ignoring risk clues is like driving without paying attention to road signs. So now the last one is ignoring the market conditions. So as you can see here on the 50-minute time frame, all the time here we are seeing a uptrend movement, and here we only open for uptrend deal from VSTG, VSFG, VSFG, VSOver block. We are not waiting for short positions because it has a strong upside trend, and only here, after the reversing in the high time frame, we can enter a good short deal, but it's not gonna give us 100% chance of success. So if you see a movement on the forex or on the crypto like that, if you see something like that, always open a short positions. It's the most simply rule what you must follow. So the last and bonus tip what I wanted to give to you, it's always take breaks, take care of your mental and physical health. Don't forget to rest. For a great view on the chart, don't forget about it. Thank you guys for watching. If you liked this video, follow all my social medias in the comments, drop your likes, and goodbye.